Welcome back. Hope you're having a good morning. Well, the SGX is suggesting for starters that we're likely to see some green. Remember, yesterday we ended virtually at the low point of the day. So good to see that on a Friday morning, at least some green is what the bulls will be looking forward to. But let's discuss a lot of stocks. To help us out with that, we're joined by Ajay Bodke, independent market analyst who joins us on the show. Hi, Ajay. Good morning. Ajay, let's talk about the top stock that's going to be in focus today. Kotak Mahindra Bank. There was a bit of a whisper that maybe we see that large trade take place where a big seller is looking to sell some part of it. What's your view on the stock? It was down 2.5%, and today, if it's done at a discount, it's likely to be a little bit under pressure yet again.
Good morning, Nigel, and thank you for having me. One had seen a lot of interest in Kotak due to the increased inflows in the MSCI a few weeks back. Let's not forget that the current seller has a total. He's planning to sort of sell roughly 1.7%, but the total holding that he has is substantially more than what is up for sale right now. So I'm constructive on the stock, but my preference still remains in the banking space with HDFC Twins. The underperformance that one saw over the last few years of HDFC Bank vis-a-vis ICICI Bank and Axis Bank, I think it's time for that underperformance to end. And as the merger process gets underway, I think one will start seeing HDFC, the combined HDFC, I think gaining the pole position in the universe of banks. So my preference remains with HDFC Bank, and on the PSU side with SBI. I also feel that IDFC Bank, although it's done quite well over the last few quarters, I think still has some more legs and some more room to run. And one should look at HDFC Bank and City Union Bank on declines.
Okay, I wanted your thoughts on DMart, because there's a very interesting note that Motilal Oswal has put out this morning where they've upgraded the stock to a buy, and they've also raised the target price to 4,200, which is a big upside to the current market price. But their main view is that they're saying that DMart has just about scratched the surface in terms of growth, and there's a long runway of growth as the modern retail space has picked up in a big way. And I agree, because, if the one step into any mall, any shopping, plaza, and it's completely packed these days. So I'm sure there's a long runway for growth. But your thoughts on DMart?
Yeah. Surya, I think what DMart has been witnessing over the last few quarters is a growth rate moderation due to mainly, I think, lower demand in the superior margin general merchandise. And that's what has been impacting the margins of DMart. So for the stock, which anyway has always been very richly priced, for it to come back and start outperforming its peers as well as the market, I think they need to ensure that the general merchandise sales, I think, start picking up. So I will be keeping a very close watch over a quarter or two in terms of how the margin profile improves due to the general merchandise sales. And that will be the trigger for me to look at the stock, because let's not forget it's very richly valued.
Okay, all right. Ajay, just a quick word on, by the way, we'll talk more about this one a little later. IEX, there was a sharp sell-off in the last 60 minutes of trade yesterday. But any thoughts? Have you looked at the news flow?
No, I have not looked at the news flow. I think yesterday I did see a very sharp cut happening, I think, especially after 2:30. I think there was a very sharp cut, but I haven't really been able to look at the fundamentals.
Okay, all right. Let's do one thing. If you have any thoughts on TeamLease, we would love to hear that, but we'll give you some time to ponder over it because we have the management on board as well.
Welcome back. We just got 15 minutes to go for the pre-open session to kick off. Ajay Bodke is still with us. Ajay, so we had the RBI policy yesterday, but my question is not about the policy itself, but there were some proposals really, about the first loss guarantee for digital entities, digital lenders like Paytm, etc. Have you managed to take a look at what this would mean, what the RBI is proposing?
I haven't had a detailed look at it, Prashant.
Okay, got it. What are you focused on, Ajay, right now in terms of what you think will do very well from here? Because it's been rotation, right? Even in large caps, we are seeing FMCG as a pack doing very well. Autos, actually, only those two have done very well. Power, perhaps, is a new sector. Yesterday, we saw NTPC rallying quite hard. What's your sense?
Yeah. Prashant, I think I've done some analysis about how various sectors are today faring in terms of the valuations. And if you look at FMCG, it is trading at nearly 110% premium related to the Nifty PE, which is the last 10 years average. If you look at it, it's average plus one standard deviation above. Similarly, capital goods is one sector I would advise investors to be cautious about, because that's again trading at average plus one standard deviation over last 10 years average. It's at 60% premium to the Nifty PE. And lastly, auto sector, that's also trading at nearly average plus one standard deviation above the last 10 years mean. All these three sectors, mind you, I think not so much consumption, but at least capital goods and autos, today investors are highly overweight. And just to give you one example about some of the exuberance in the capital goods sector, I was looking at Siemens and ABB and comparing the valuations vis-a-vis their own parent. And if you look at the revenue growth for, say, Siemens Limited, that's the Indian company, from 18 to 22, it's at around 6.5% CAGR. The parent's growth has been 6.7% in the same period, slightly higher. And Siemens today is trading at 7.3 times EV to sales, and the parent is trading at 2.1 times EV to sales. So there's a 372% premium at which the Indian entity is trading vis-a-vis the parent. And mind you, the operating margins for the parent are better than the Indian entity. The same holds true for ABB too, where ABB India's growth has been 6.2% CAGR between 18 and 22. Whereas the limited, which is the parent's growth, has been slightly lower at 3%, 3.2%. But the premium, again, the parent is trading at 2.5 times EV to sales, and the Indian entity is trading at 9.3 times EV to sales. Again, the operating margins being better for the parent than the Indian entity. Now, you could argue that there are strong tailwinds, like strong order book inflows and backlog that the Indian entities have. But whether the parent, the fact that parents have better operating margins, and whether the strong order book growth itself is justifies enough for the Indian entities to trade at such a premium is something that I am not comfortable with. I think if you just go back in case of IT sector, when it was the exuberance was very strong, people thought that the premiums would continue. Something similar I'm sensing in case of capital goods companies, and that's why I would advise investors to be cautious there. To answer your question, to conclude, I think IT and pharma are two sectors where, if I look at the valuations today and the under ownership, I think one can be selective in terms of looking at some picks out there.
Ajay, it's a pleasure. IT and pharma is the spot that you want viewers to keep an attention on. Otherwise, valuations elsewhere a little higher. Now,